All right, hello everybody. The Avalara webinar will be starting soon. I see people shuffling into the webinar room here, so just wait a few more seconds and get started. All right, looks like we got a number of people on the webinar. So again, this is Rick Wilson with Martin Associates. Hope everybody's staying safe and healthy out there. Thanks for taking the time out today to join us. We've got our presentation with Avalara on Sales Tax Nexus 101, and that's going to be presented today by Kevin Anderson. Spoiler alert, there are 5 critical takeaways at the end, so you're going to want to wait till the end. But before I turn it over, a few housekeeping items. We are recording the presentation, so we'll be sending out the links for that in emails after the webinar. And then as you have questions, go ahead and put them in the Q&A, and then we're going to wait till the end to go over all of those, and we'll answer. We should be able to get to all of them, so we'll go from there. So that's all I had, Kevin. So take it away, and thanks again for your time today.
All right, thanks, Rick, and thank you guys all for jumping on the line today. As Rick introduced me, I'm Kevin Anderson. Been working here with Avalara for the last 4 years, and actually this is the 3rd year that I get to work with Rick and Martin Associates. And my primary job is working with Martin and team and their clients to better understand if they do have any concerns around sales and use tax compliance, or if they want to explore sales tax automation. And working to put together a good project to address their needs. But today we're gonna take a little bit of a step back and really focus on Sales Tax Nexus. And when we're talking about Sales Tax Nexus, really just to quickly define that, Nexus is the obligation to establish and maintain compliance with a state. And when we're talking about sales tax, that has to be done on a state-by-state basis. And so today we're really gonna dive into what creates that obligation with these different states, or what can create that obligation. And as Rick kind of gave a little foreshadowing there, I am going to be running through kind of 5 critical checks that you can go back and use to double ensure that you're not creating or that you don't have any outstanding exposure or growing any exposure in any new states. That way we're making sure that you have a pretty quick and easy way of double checking that your company is safe and secure when it comes to sales and use tax compliance. And one of the questions might be, why now? Why is this a topic that we're jumping into today? And really, at the core of it is that sales and use tax is pretty complicated. The more you dive into it, it's not quite as point and shoot as going to the store and paying the 6% on your clothing as you're checking out. In fact, when it comes to sales tax from a business standpoint, it gets pretty complex pretty quickly with the different ways that states can enforce Nexus, the different ways that a business can create Nexus. Once you have that obligation with the state, every county has a different rate. Every city, every specialty jurisdiction, they all have their own set of rules, and those rules change on a regular basis. The taxability of the actual products that you're selling, those change on a regular basis, and it's a lot to keep up with. And as Nexus creating activities, as that term of Nexus broadens, 90% of businesses are having to expand their compliance landscape or their footprint in the states that they're registered in. And so the cost of compliance is rising year over year. for most businesses. The other piece is that the tough to manage piece is that compliance isn't optional. It's not something that you option into. It's something that once that obligation is created, the state then requires you to provide your compliance within their state or face fines and penalties. And so if the state does reach out to you, the onus is on you to prove why you either have registered or haven't registered. It's the burden of proof is on you for if you are registered in that state, why you haven't charged sales tax on some transactions, why you charged a specific rate on others. And it all comes down to your record keeping and playing from behind. If a state does reach out to you before you register with them, they're actually able to hold you liable for some back taxes, including penalties that they assess off of those taxes and interest that they also apply. And then the kind of next question that pops up is, well, why now? Why is it that this is of high priority here in February of 2021? And kind of the long and short of it is that states are hurting for money. So even before COVID, with the onset of online sales and interstate commerce, states ran a couple reports and they realized that they were down about $13 billion in sales tax remittance. So the way the states are viewing that is as a $13 billion deficit. And then when you combine that with the year of 2020 and the national pandemic and some other activities, most of these states are actually operating off of a real deficit. And they're needing to take part in some activities to try to raise some revenue. And what we've seen here at Avalara, they're in their efforts to recoup some of that deficit, is they're actually changing the taxability of a lot of products and services that traditionally have been deemed non-taxable. So states are getting a new revenue source that way. And the other thing that we've seen is that states are, for lack of a better term, doubling down on their audit efforts. And so a lot of states are doubling and tripling the number of auditors that they have on staff in preparation for kind of an audit blitz to try to recoup this some of these funds. And actually within Avalara, year over year from 2020 to 2021, we've seen an increase of audits amongst our clients by 15%, which is pretty high just for the first month of the year. Now, one of the things that I really want to make sure that you guys are walking away from our conversation with is that, yes, states are looking for these funds. They want to make sure that businesses are staying compliant with them when needed. And so I want to use this time to review kind of what states have in their toolbox that they consider, or the laws that they have in their toolbox that they can enforce Nexus through. And so we're going to call these Nexus creating activities. And this is the business activities that you can take part in that would create the obligation with the state or create that Nexus with an individual state. And this is where our key 5 takeaways is really going to start to form out, because traditionally Nexus has been thought of as when it comes to sales tax, oftentimes businesses think it's just where I physically am, where I'm headquartered. And really, when it comes to physical presence, there are quite a few laws that have been in place for the better part of 2 decades that detail out that physical presence is a pretty wide definition. And in fact, conversations that I have with companies every day, one of the biggest gotchas that comes up when it comes to physical presence nexus is remote employees and contractors. And if a business, so this is kind of the first takeaway, is to go back and make sure that if you do have any remote employees or any 1099 contractors that are on your payroll, if they are located in a different state than your headquarter, there's a very good chance that you've created an obligation in that new state through your remote employee or your 1099 contractor. That is one that comes up on probably 50% of the conversations that I have. Another form of physical presence that a lot of businesses do not address, or that often goes unnoticed, is common ownership. So I work with a lot of companies that have affiliate companies that all roll up to one holding company, or they affiliate or sister companies that all roll up into one board of director, that maybe that board has different shareholdings in each of the companies, or different members of the board have different shareholdings in the different companies. But that relationship, or that common ownership, creates what we call an affiliation between all of those businesses. And so with that affiliation, all of the businesses that have that relationship are required to share a sales tax compliance landscape. So they all have to be registered in the same states, and they all have to maintain compliance in the same states because of that relationship that they all share. And that one that oftentimes comes up in conversations as going unaddressed for quite some time. So again, we got the remote employees and common ownership. The third takeaway that I want to make sure that you guys are able to walk away with is kind of an indirect physical presence. And this is really commonly where I see this one taking place, is a lot of businesses will offer nationwide maintenance on their products, or maintenance services that either they're free or they are charged for. And then these businesses will, across the country, either hire a third party to go in that's local, to go in and conduct that maintenance on their product, or they'll actually send their own team into the new state to conduct that maintenance, and then head right back to the headquarters. Both of those scenarios, if the maintenance is happening outside of your home state, whether it be through a third party or an in-house team, those both create nexus within that new state. And so the third one to double check is if your team performs any sort of maintenance or contracts out any maintenance across the country or into new states, then you'll want to double check your obligations in that state. And the last one, when it comes to physical presence, that often goes unnoticed, that's becoming more and more popular, especially with Amazon and some third-party distributors, is if you do store any inventory throughout the country. So again, no employees, no headquarters to speak of, but just storing your inventory at a third-party distributor, or if you do contract out a third-party warehouse to hold inventory to ease shipping times. Any state that you are holding inventory in, that physical presence of your inventory creates nexus. And so kind of the fourth takeaway is, the fourth takeaway is if you hold inventory outside of your home state in any form. Those all create obligations with these new states. And if a state does reach out to you, they are able to hold you liable for the sales tax from when you first started those activities in those states. Now, again, there's a whole lot of other ways to create nexus, but those were the four that I see most commonly that are unaddressed. The fifth is called economic nexus. Now, this is the new kid on the block. These laws went into effect in 2018, and they are a little bit different than the physical presence nexus laws that have been around for a long time. These guys are new, and they're not based off of your physical presence at all. They're actually just based off of how much you sell into each individual state. So as we're looking at this map, each state that's colored in blue has some form of economic nexus law on their book. And these states have dictated that based off of the amount of sales that you sell into their state, if you break their threshold of sales, that creates nexus just the same as if you opened up a new headquarters in their state. And you then need to establish and maintain compliance in their state, just the same as if you have a physical presence. Now, each of these states have a different a different set of laws, and some of those are detailed over here on the right. Just with each state having their own autonomy to put in place the laws that they see best fit. That being said, if you are selling outside of your home state, you will need to look into your last year's sales and see whether or not you've crossed any of the thresholds that these states have in place. So that's the fifth takeaway, is if you are selling outside of your home state or across the country, whether that be online or through traditional sales routes, you will need to double check how much you've sold into these states and cross-reference that against the thresholds that they have in place. Now, kind of our 5 takeaways are what we call, or here at Avalara, we call those Nexus triggering activities. And so there are some common triggers. These are a little bit more detailed. Again, a little bit more detailed than the 5 takeaways. But once you determine if you have created an obligation, one of the common questions that comes up is, most of my sales are exempt, so there's no sales tax to account for. And it's not that. So I do want to make sure that I'm defining this out well. Is that Nexus, what we just walked through? You got the 5 takeaways around. That is around the obligation to establish and maintain compliance. When it comes to the business, or your specific business, that maintenance may look different than in other businesses. And in the case of manufacturing or manufacturers, distributors, really anybody that's selling mostly to exempt customers, your maintenance is more centered around collecting and maintaining exemption certificates, and then filing and remitting sales tax to the state. Again, those filing and remitting or remittances, they're probably $0 remittances, but they do need to detail out your sales by the state in order to detail out the sales, so the state has record of those. Now, when it comes to exemption certificates, as you're expanding into new states, you do need to collect new exemption certificates from each of the customers in that state. And in fact, I'm recently working with a company, Braeside Manufacturers, that has gone through a very similar scenario as what we're looking at here within New York, and where, when maintaining compliance within their home state, really only having to focus on about 75 exemption certificates for 75 customers. But then as they expand out into about 15 new states, that actually has to, the number of exempt customers that they need to account for actually shoots up to about a little over 1,000. And very similar with the other case study that we have here. In general, once you learn of a new obligation in a new state, all of the customers that you have within that state now need to provide you with that exemption certificate, so that in the case of an audit, you can present that and not be held liable for those sales taxes. But one of the biggest difficulties is knowing exactly what exemption certificate to collect. Do you need a manufacturer's exemption certificate? Do you need a research and development exemption certificate? Or do you guys prefer to use direct pay permits from your customer base? Are there multi-jurisdiction exemption certificates that may apply to this company for more than one ship-to location? Really making sure that you have all of those filled out correctly, that they are valid with the right information on there. And up within or on hand in the case of an audit is your form, or is that form of maintenance, of compliance maintenance. And once you have all of those exemption certificates on file, you then need to, again, be able to file and remit to the states. And so being able to fill out the returns, get them to the state on time, aggregate any sales tax determinations that you may need to collect from any sales, taxable sales, and notate those on the returns, as well as being able to keep track of any changes in how the state wants you to file and remit on an ongoing basis. And so with that, understanding that the ongoing maintenance is not really the area of focus for our conversation today. Really the key is the 5 takeaways around if there are any new obligations that your company needs to address. Again, the 5 takeaways are double check that if you have any remote employees or contractors outside of your home state, if your company and subsidiaries has any subsidiaries or has any sister companies with common ownership, if your company does perform maintenance throughout the U.S. or outside of your home state through contracted third parties or from your own team, and then the 4th one is if you do store inventory outside of your home state through any third party fulfillment centers. And the last one is if you sell outside your home state, being able to address or check economic nexus. Now, I'm happy to follow up with everybody on the line and make sure that if there are any follow-up questions or more detailed questions, that we're able to address those. The other piece the other way that Avalara is positioned to best assist businesses with questions around nexus obligations is through our sales tax risk assessment. And so being able, this risk assessment is a formal review of your business activities, and a tax attorney will then determine if any of those activities have created an obligation in any states. And so takes us about a week, and then we're able to give you back a cut and dry list of every state that you have an obligation in. And if there are any unaddressed obligations, you're then in contact with our professional services team to walk through the best options in establishing your compliance or addressing that past compliance moving forward. And so we're happy to do that one. And for everybody that attended the webinar today, we're able to do that for half off. So it saves you guys about $2,200. And happy to do that if there are deeper questions around some of your specific business activities. All right. And so again, I mentioned I'm going to be giving you guys a call just to double check that there's no follow-up questions from you or your team. But here is, if you do want to reach out proactively, happy to put up my contact information. Feel free to give me a call or shoot me an email, and we can have a quick conversation.
Great, thanks, Kevin. And certainly, everybody on the line, you can contact who you work with here at Martin Associates as well. And yeah, we've had a couple of clients do the risk assessment. It gets pretty in-depth, so it's if you've got a complicated situation, it's not a bad thing to do. All right, well, thanks for going over all that, Kevin. There were a couple of questions that came in through the host. Let me see, does economic nexus only apply to online sales? How else would the sales economic nexus work, I guess, is the question.
Yeah, no, and that's great. And to be honest, that was a common misconception when economic nexus first rolled out in 2018. Most of the news outlets called it the internet sales law, or internet sales tax law, and that's a little bit misleading, and actually did a bit of a disservice, because all of these states do look at your total sales into their state. So through any route to market, a sale into that state will count towards that threshold, with the exception of a couple states that look at taxable versus non-taxable. But the actual route to market does not play into effect.
Okay. Another one here about the whole exemption certificate collection. What about governmental agencies? I don't know if those, I think everybody knows that they're not taxable, but do you have to have the certificates?
Yeah, the big one that we see that people get audited for or get dinged on an audit. Now, federal government in general they they have exemption certificates that you can collect. Those usually don't. Kind of in a practical stance, the auditor knows when the federal government's purchasing something. It's when it comes down to those state those state entities. So oftentimes schools, union or state union boards, things along those lines, where it's not quite evident that it is the state entity. Having that exemption certificate on file is what will ease that audit process as much as possible.
Okay. All right. And it looks like the last one, I think we covered this a little bit about the whole, collecting exemption certificates, from other states in your example. So this is, I guess, confirming. So every state that you would ship into, that can sometimes require getting exemption certificates for those.
Yeah,
it's states. Is that?
Yeah. So if you do have an obligation in that state, then you would need to collect exemption certificates from your exempt customers in that state. The other kind of the one thing that I didn't touch on is that if you have a customer with multiple locations to different states, and in that scenario, you will need to collect an exemption certificate that covers all of their different locations. And there, a lot of businesses will utilize a multi-state exemption certificate. Those usually cover, I believe it's about 30 of the 46 states allow for a multi-state exemption certificate. There's a couple out there that won't, that you need a specific exemption certificate from that state. Florida's notorious for it. They're real difficult to deal with when it comes to exemption certificates. But most businesses will collect that multi-state exemption certificate and keep that on file for all the different ship to locations of one customer. Yeah.
Okay. All right. That's all that I saw that came in. So guess we're kind of right at the end of our time here anyway. So so if you have any other questions, like we said, you certainly can reach out to Kevin. You can reach out to your account manager at Martin Associates. And I guess that's it. Do you have anything else, Kevin? Or
no, I think that that pretty much covers it. Thank you guys again for thank you, Rick, for letting me come talk, and thank you everybody for jumping on the line.
Yep. We value your relationship with Avalara, good products, and so our customers are happy usually. So that's good. All right. Well, thanks everybody for joining. I appreciate everybody else's time on the line, and everybody have a good day.
Have a good one.
Thanks. Yep. All right. Bye-bye.